charitable lead annuity trust, otherwise known as a CLAT, is a trust through which charitable beneficiaries, known as the lead beneficiaries, receive payments annually from the CLAT for a number of years, and then the grantor's non-charitable beneficiaries, usually the children or continuing trust for their benefit, receive the trust assets remaining at the end of the term of years. A CLAT is also referred to as a split interest trust. This is because the beneficial interests in the CLAT are split between the initial charitable beneficiaries and the non-charitable beneficiaries that receive what remains at the end of the trust term. A CLAT typically makes sense for a high net worth individual, more than $20 million or so, who want to make charitable gifts while also transferring wealth to their heirs without using a gift tax exemption. If you have significant and unusually high taxable income in a particular year, you can create and fund a grantor CLAT in which you are the taxpayer for income tax purposes and benefit from an immediate income tax charitable deduction to lower your personal income tax bill for that year. For example, your income tax bill may be unusually high in a year which you sold a business, received a large bonus or commission, made a significant IRA withdrawal, or even enacted a Roth conversion. The income tax charitable deduction could be as high as the initial funding amount. So CLATs work best in a low interest rate environment and down markets. Each month, the IRS publishes their hurdle interest rate called the 75/20 rate. The lower the 75/20 rate, the smaller the amount that must be paid to the lead beneficiaries, leaving more value in the CLAT at the end of the term for their descendants. CLATs work well in a low interest rate environment because if CLAT's growth exceeds the 75/20 rate, then this excess growth passes to the grantor's descendants gift tax free. Also, the more undervalued the CLAT assets are at the time of funding, the more likely those CLAT assets will grow over the CLAT term when markets rebound. To maximize transfer benefits over the CLAT term, the CLAT should invest in securities or other assets with high growth potential over time, or an asset, as we mentioned earlier, that's grossly undervalued. Also, funding a CLAT with income-producing real estate or stock in a closely held family business can also be a good option.